How's it going today, folks? Today we're going to be doing a review on QDVO, which is Amplify's newer income and growth ETF. I've been getting a lot of questions on Amplify ETFs and QDVO in particular, and it is a very intriguing product. So I definitely want to look at this product, outline its benefits, outline some of its drawbacks, and just kind of make an assessment of its current structure. So let's jump right into it. Firstly, I wanted to shout out all of my new Patreon members. I'm talking about Waldir, Mike, Robert, Sandro, and Chad. Thank you guys so much for joining the community. I really do hope it's been helpful and you're finding value in it. If you'd like to do the one-on-one coaching, just please message me and we can do so. Or if you're grabbing the calculators or just grabbing the content within the Patreon, hopefully it's been of great value. If you guys do want to join, we have an entry tier at $5. You'll get access to all the calculators and have access to the community chat. Or the elite tier offers you one-on-one coaching on a monthly basis and also all the other benefits from the entry tier. So please jump on board if you'd like to join the community, and it really does go a long way, so I appreciate it. All right, guys, so we are here at the QDVO sub page within the Amplify ETF's website. Of course, they are ran by Amplify, but also they are ran by Capital Wealth Planning, led by Kevin Simpson, and they've been managing billions in ETF portfolios since 2005. While the Amplify team and this structure is a little more new. They do have a lot of historical background in managing ETFs, and you can look at their about us and look at their team to see who they all are and their expertise in the market, and they certainly have a lot of expertise. Okay, so what is QDVO? What is it all about? Well, QDVO is an ETF that helps inspire and helps build growth while generating high income. So they're looking to seek capital appreciation from a selection of growth-oriented stocks while also providing monthly income in the forms of options, premiums, and dividends. Okay, the equity exposure and lower volatility is built based on their covered call and dividend strategy, and that covered call and dividend strategy is going to help reduce its volatility, ideally during market declines. Note that this is an actively managed account. Actively managed ETF, and with that, there's a portfolio manager that will identify opportunities and adjust accordingly as they see fit, and so they'll make decisions in real time, and that can be a benefit or a negative. If the manager is making the right calls, that's a benefit. If they're making the wrong calls, that's a negative, right? If they have a lot of in-the-money options that aren't doing that much, if they're doing a lot of out-of-the-money calls that are maybe providing a bit of upside, that's a good thing. So it's just a matter of, is this, do you buy into this management team? Do you buy into their structure? And it is a newer fund, okay? It started in August of 2024. They only have 200 or so million in assets under management. And with that, though, the expense ratio is quite favorable. We've seen like QQQI have an expense ratio of, I think, 0.68. So this expense ratio for an actively managed covered call strategy is quite favorable. You'll note that, this isn't your typical just, QQQ, cover the index ETF. They're only holding 42 holdings at any given moment. And so they're, looking at more high cash flow, tech-oriented holdings. And we'll look at those holdings right now. So you can see they have 42 holdings, primarily focused on tech: NVIDIA, Microsoft, Apple, Alphabet, Amazon, Meta, Broadcom, AMD, Netflix, Tesla, Visa, Home Depot, Costco. I know they have Palantir in here. They have Robinhood, P&G, some value, Hasbro, DraftKings, Coca-Cola, Spotify. Kind of a mixed bag of primarily tech and some value. And then you'll see they also, of course, have their call options for the covered call strategy. Now, as far as I've researched, about 80% of their holdings are just equity holdings, and 20% of what they do is going to be covered call and looking to seek income. So that's kind of the split. I think it's like an 80-20 split, and that is subject to variability. That might change, but 80% is focused on capital appreciation and then 20% of the portfolio is focused on seeking that income and building that income. All right. And so, as it says here, again, it's seeking capital appreciation and secondarily income. All right. So its distribution rate, it's right now its target distribution rate for the annual period is 9%. 9% distribution rate, which aligns pretty good with like a JEPQ or even a Q pick from Goldman Sachs. So it's right there. And then, we can look at its performance in terms of total return. But if we look at its distributions, over time, it started at 20 cents, 20 cents, 21 cents, 22 cents, 24 cents, 22 cents, 21 cents, 28 cents. So the distributions are in fact growing, and that is because their NAV is actually increasing. And so I want to walk through their performance, both total return and distributions or dividends as well. All right, guys. Okay. So if we're looking at the past year, and again, this asset really only has 1 year of track record to work off of. So we're going to do like a 1 year look back. And so we're going to compare, first off, its price action. So just its price appreciation versus some of these other players, right? So we can look at QDVO versus some of the other top covered call income players. And you can see that it's done 14%, 15% from just a price return standpoint over the past year. Compare that to a QQQI and a GPIC. QQQI has done 5%, and GPIC has done 8%. So in terms of NAV growth or price appreciation, QDVO definitely takes the cake. And why is that? Well, as I mentioned, a lot more of their holdings are just being held and left for capital appreciation, as opposed to these two strategies are more focused on income. So the majority of their assets are going to be shifted to covered calls and seeking that premiums. These guys are doing much more of a equity split where they're allowing the equities to sit on their books. And then also with their holdings, they're much more selective with them. They have 42 holdings, whereas this is going to be 100 holdings, and this is going to be a larger set of holdings. So QDVO is being much more selective, and truly I like the selections they've chosen. There's a lot of upside in tech. So I do like where their head's at. And if you compare QDVO to your VOO and your QQQ from a price return standpoint, just from price return alone, QDVO is almost matching the S&P 500 and does trail QQQ. But when we look at the total returns, over the past year, we can see that QDVO is actually leading in all respects. It's leading, it's beating QQQI, GPIC, the S&P 500, and the NASDAQ 100 in terms of total return, which is quite intriguing. It's done 26% in the past year versus QQQI 21%, GPIC 20.88%, VOO 17%, QQQ 21% or 22%. So in terms of total return, QDVO, the combination of growth plus dividends, we can't deny it. It's done really well. Now, again, this is an actively managed fund. This is a selection of 42 holdings. So it is a different approach versus these other indexes. And so you have to bear that in mind. But just on the face value of its returns and its expense ratio, they have something going on here that is quite intriguing. They definitely do. I wanted to show you guys the dividend yields once again. So the trailing 12-month dividend yield for QDVO has been 9%. And imagine that, you can seek 10% plus in price appreciation plus a 9% dividend yield. What world are we living in? This is amazing. And that's not going to be the reality every single year, of course. And again, they're very, very new. So you want to keep that in mind that they're very new to the market. But anyways, in terms of their dividend yield, it's 9%. QQQI, 13, 14%. GPIC around 10%. VOO, of course, 1.1%, very low. And QQQ, 0.49%. So, it's quite interesting, right? When you can see here that price return of 14% plus a 9% dividend. Now, again, we have to buy into their covered call strategy, and they do have a mixed bag of both in the money calls and out of the money. Those in the money calls really are just going to be seeking premiums. You're going to be getting income, and you're not going to be getting any upside. Those out of the money calls have a better chance of seeking upside, but of course, when it comes to their cover call strategy, I think it's just purely about the income as opposed to trying to drive any capital appreciation on their covered calls. They're going to let the equity side deal with driving capital appreciation. So very intriguing, interesting stuff. All right, now I just want to talk a bit about their tax structure. And I know we've spoken about taxes in the past as it relates to QQQI, but this is also quite interesting as it relates to their taxation. So if we look at this chart, it's one of their last distribution outlines of their with taxes. We can see that actually 100% of their distributions were classified as return of capital. Okay, this is not just giving your money back to you. Of course, this is return of capital. It's a classification where they classify the income premiums as return of capital, and what that's doing is reducing your cost basis of your asset, and effectively you don't have to pay your taxes. When you receive that distribution, you will reduce your cost basis and pay when you sell your funds. I'm not an accountant. Please refer to your accountant for actual tax advice. Also, this is all for educational purposes only, so please keep that in mind. Okay, guys, are you invested in QDVO? Let me know in the comments below. I'm going to continue to do some more series and some more videos on Amplify's ETFs because I think they are intriguing and something we should be looking into. Outside of that, guys, please leave a comment below, subscribe to the channel. All the best and cheers.